All right, well, good evening, everybody, and welcome to the fresh first roundtable of 2016, our January session. We are kind of celebrating a week before, well, actually 2 weeks before the Super Bowl, Super Bowl 50 for the National Football League, and be a little bit of festivities around that. And again, welcome, especially some of you that are joining us for the first time. We do try to keep these programs at about an hour and 15 minutes, including the question and answer period. But welcome if you're returning, and extra big welcome if you're here for the first time. Um, let's go ahead and get underway here. First, we have to take care of a little bit of the legal paperwork here. No recommendation whatsoever is intended. This is meant to be an educational demonstration. Everything that we do here is to illustrate the philosophy and processes, the methods and the types of approach to investing that we do as members of this community. So we will talk about real companies. We'll even talk about companies that we own. We try to disclose when we do that, but again, this is intended to be a demonstration and a source of ideas. We're sharing ideas and illustration only. If you'd like to be added to a reminder list on future meetings, and by the way, we did go ahead and lock down the last Tuesday of every month for several months. The only exception so far is May, when we will be presenting live from the Better Investing National Convention in Chantilly, which is code for Washington, D.C. in May. But other than that, just kind of watch and kind of make it sort of like the investment club routine of meeting on the same date or day every month. So if you want to be added to a reminder about any of the future sessions, again, you can send an email to Natalie Kavula, that's nkavula1 at comcast.net. And then my email address is there if you have any questions or would like to do some follow-up. Here's our standing agenda. And again, we just want to have an extra big Happy New Year welcome to everybody. We'll spend some time talking about results and performance to date. We've been doing this now for 5.5 years. Didn't really have a challenge jump off the board unless any of the guys that are here, and he is probably going to be joining us. We do expect to hear from him, so we may have to shuffle the presenting lineup, but you can see the three stocks that are going to be presented. Ken and Cy have assured me that there was no collusion or conspiracy. They both ended up with the same stock, and I have to admit, I almost ended up with the same stock, so I'm kind of glad that we ended up with at least three. We do have an audience poll after we do our three presentations, and we do have an open question and answer period at the end. Let me just take a moment and just point out what we've been doing. Again, for 5.5 years, the four of us or guest damsels or guest knights come and share an idea. We basically walk through the idea, take a look at some of the key judgment factors that we do during the analysis or stock study of any potential opportunity, and just kind of walk through that. We do keep track of how well they do. We would like for the average of everything that we do to beat the market by 5 percentage points. That's the 5% that you see on your screen here. And we do like to be right 60 to 70% of the time. So those are our objectives. Here's a quick look at the scoreboard, and somebody ring a bell because we are actually hovering near an all-time high. We're almost up to a 4 percentage point relative return. Again, relative return isn't a complicated thing. It's literally taking the actual results and comparing how well we would have done if that money had just been invested in the general stock market, the Wilshire 5000. We want to beat it by 5 percentage points or better. You can see we're kind of approaching that number as we approach that 5.5 year point. The actual rate of return of those investments, by the way, using our internal rate of return calculation, it is almost 12%, that 11.8% you see down at the bottom. And the number of selections that have actually done better than the market since the time they were chosen is up to 54%. We'd like to see that get a little bit higher, but again, ring the bell, pass the Super Bowl trophy around a little bit, and let's hope to see us keep making progress towards that red line. Any questions or comments, Ken?
Well, you could start to make that night a little bit more svelte, Mark. You and I both have taken off a few pounds, so maybe you could stretch that figure the next time, that graphic, the next time it goes onto the sheet here.
And Cy and Hugh always stay pretty trim, so maybe we could go with a more average night.
Yep. It's probably a little too early to know what's going on. But if you, of course, realize that over the last 5.5 years, the market has generally been in a pretty steady uptrend, and of course still is even after the January
Hmm.
disaster, according to the pundits. Um, but I have always felt, and I think anecdotally at least, it seems true that the better investing NAIC manifest approaches really start excelling against the market in down markets.
Yeah, and that
I
I think
I agree with you 100%, Cy. I've been through a number of down markets now, and my portfolios never seem to sink as low as the market, however you define it, goes. And I always seem to recover a little bit sooner and a little bit better than the market as a whole. And again, whether you define it as Dow or S&P 500 or Wilshire 5000 or anything like that, uh, it's a really nice to stay abreast of the market during really hot markets, but I think the strength of the process lies in what happens when the market is really kind of nasty to the average investor.
Right.
yeah, and just to make that point, it really is a function. I think it's more than a theory. It's the quality. If you have enough quality in your portfolio, and that's basically strong companies, they just don't get hit as hard during the downturn. If the average stock was down 10% in January, I'll bet the average stock in most of our portfolios might have been down 2 or 3, maybe 4%. And that kind of a difference over the long term really starts to stack up. And some of what Cy is pointing out, that we tend to not get hit as hard, and in many cases, especially if you have enough small companies, come out of those corrections and recessions and bear markets a little bit better than most people. So good stuff. Let's hope we crack that red line sometime this year and stay in that 5 to 10% zone. And one of the things I probably should point out is that we had a couple companies actually take a pretty good hit. Hugh McManus was up like 80 or 90% with Ardelyx. The company presented probably a little over a year ago. Well, that dropped about 80% in the last 2 months, and we've been able to weather that even in the portfolio. So pretty good
Well, we've
stuff.
had some big hits on a couple of good-looking stocks also. Polaris has taken some really big hits. A PRA group has taken some pretty big hits. Some of it having to do with currency, some of it having to do with acquisition, some of it having to do with the way that they're manufacturing and some mistakes they've made. But even though we've had a couple of our stocks take these really large hits, I think that what we're doing is just demonstrating the strength of the whole process and the strength of the manifest investing / better investing methods.
Absolutely. And what we're looking at now is the most influential or the largest positions in the tracking portfolio. You don't have to be a Manifest Investing subscriber. That link up at the top is a public link, accessible at any time by anyone. And we basically use this to track the portfolio. And again, just really quickly to decode it, the number of times a company has been selected or repeated is listed up at the top. So for, in this case, Cognizant Technology has been selected 12 times. I know that Cy almost picked it again tonight. 12 times, $1,000 invested each time is now worth 18,000, almost $19,000. So any one of those listed transactions up there, you can see the number of repeat selections. And I hadn't noticed until you mentioned it just before we got started, Ken. ResMed has actually crept up onto this list down at the bottom there. So it's
Yeah, it's been on a roll recently. They've had some good earnings reports, and the market has rewarded it. There's been a couple of times when it's been one of the few up stocks in my entire portfolio. So
and I'm pretty
we've
comfortable with
only chosen it twice. Yeah.
yeah, I'm pretty comfortable with the way Mesa Labs has been behaving too over the longer term. That's where is Mesa Labs? That's actually a 5-time selection now, but it's up to $7,400 now. So again, $5,000 up to $7,400. And this list is continuously maintained and adjusted for splits and dividends, so it becomes a fairly reliable tracking method. Now, if I had sorted it looking for the weakest return forecast, the worst ones that we have are down around 4 or 5%. So I didn't figure we wanted to spend any time on thinking about things that we might sell tonight. So I think we'll just go ahead and get into our part of the program. Hugh, you're not online yet, are you, Mr. McManus? So we'll come back.
No, I don't see him. I don't see him yet, Mark.
Okay, so we'll come back to this one. He is going to select Conoco Phillips, but we'll come back. And I'll just go ahead with my part. I'm going to go ahead with my selection of Hibbett sporting goods here tonight. Here's our Sweet 16 that we put out just a couple of days ago. Companies that basically are ranked at the top on the basis of the return forecast, which we use the projected annual return as our return forecast, and the quality ranking. And again, those two things in combination, we basically take those two things and say, okay, let's take the best of those two situations, and then the rest of the stuff is just gravy or decoration from top to bottom. And if I were investing real money, I would literally be looking at Apple right now. Apple looks pretty good at it's under $100. I think it closed at $99.99 tonight. So, you know, Morningstar sees it as pretty attractive. That's basically suggesting it's on sale. Pretty decent return from Value Line. And then over the next year, the analyst consensus, S&P, and that'll be Goldman Sachs for Apple, all have pretty good outlook. So it's one that I wouldn't be afraid to go to, but we have gone to that one several times. How many times selection is it? Probably a 6 or 7 time selection. So I would pass on that one. Notice that Cognizant's up at the top, tempting Psy. Under Armour, that one's a little bit tougher call. We might talk in a little bit more detail about that either in the Q&A or a future month. I mean, in order to get those type of returns that you see listed there, it's going to have an average PE in the 40s, and most of us are not terribly comfortable with that. Ken's recent selection of Buffalo Wild Wings is on the list, and then notice that Ken and Psy's selection of Biogen, again, this is one that looks pretty good to me across the board. Very decent return, very high quality, and every one of these analyst expectations is pretty solid for Biogen. So it's a worthy study, and I'm glad the two of them are bringing it tonight. But just kind of cranking down the list, Ken's study on PriceSmart, that's the Caribbean Costco. That's continues to look interesting as a long-term situation. Synaptics, Fleet Corps, and companies that we've talked about from time to time. These are all pretty decent studies, which brings me down to Hibbett. Sometimes I'll back down this list just so I'm not feeling too frisky. Hibbett, second one from the bottom of this list, has a really nice looking return forecast, excellent quality. Value Line has a pretty decent expectation for it, and all of the rhinos that we follow think it's pretty much on sale. By the way, the average 1 year return, according to the analyst consensus right now, is between 25 to 30%. So that's, again, for the next 52 weeks, and that's largely due to the carnage that's happened in January so far. Probably started the year at 15 to 20, and now we're all the way at 25 to 30. So, but Hibbett looks pretty good from all those respects. So that's one of the reasons I picked it. Did want to just remind everybody that we do every Thursday night or Friday morning put out a list of 5 companies that are probably worthy of a study. Apple, Forward Air, Cognizant, they all continue to be on that list, along with Under Armour if you have a particularly long time horizon and a decent risk tolerance. But you can also go to that link at expectingalpha.com and check out the 5 of any week. Again, they're all worthy of study, but not what I'm after here tonight. So let's go ahead and switch into Hibbett. Hibbett Sporting Goods, many of you have probably been in the stores. They're in 32 states nationwide. It's nothing fancy. It's a sporting goods store, specialty retailer. They are an official sponsor of the Super Bowl. So the 50th Super Bowl probably will have a Hibbett commercial or two or something going on as Peyton Manning takes on Luke Kuechly there in the Carolina Panthers. By the way, we all have to be rooting for the Panthers. Sorry to those of you in Denver, but Denver is an old AFL team, and the Carolina Panthers are going to have to fill in as an NFL team. And those of you who follow the Super Bowl indicator, know that we can't have the Broncos winning or the stock market's going to continue to tank, according to the Super Bowl indicator. Again, nothing really fantastic about the store or mysterious. They sell sporting goods stuff. You can see it's pretty much up straight and parallel. You can see the impact of the Great Recession here as the stock prices did get come under some pressure in the 2008-2009 time frame. That's because earnings basically sagged a little bit during that economic moment, but it's been pretty good. A little bit flat here the last few years. The stock price has been on the decline as these earnings have been a little bit flat. But you can see from top to bottom, not too bad of a picture, not a whole lot of sensitivity to the economy. I'm going to be buying a tennis racket tomorrow. I may go to Hibbett Sports to do that. And based on either the analysts or value line, we're talking about an upper teens return forecast, and that's certainly pretty good compared to a 9 or 10% median or average right now. Here's a look at the profitability and the valuation in the form of the PE ratio. You can see that, again, this is no different than section 2A of a stock selection guide, just looking at a picture of it. The trend is good. You can see the evidence of the Great Recession back in the 2008-2009 time frame, but I wouldn't have any trouble picking out a projected net margin in the 6 to 7% range, somewhere in this range, and being fairly comfortable with it. Again, compared to an average retailer, that's doing pretty well. The PE ratio has been maturing a little bit of disturbance in the force here, 2015, but again, a PE ratio somewhere in that 15-ish to 17-ish range would make sense to me, and that's what would apply. One of the things you can do at Manifest is when you're on the company page, you can click through into a quick instant industry study, in this case taking a look at some of the competition to make sure that we're shopping amongst the highest quality companies, and again with companies that have a fairly decent return. And you can see that Hibbett and IDEC, by the way, is about 3 times as large as Hibbett. Hibbett has room for geographic expansion, whereas IDEC is pretty much nationwide at this point. The other ones are a little bit more specialty. The two at the top are really head-to-head. And just gives you a really good feel for the industry characteristics from top to bottom. We're talking about companies that are basically growing in about the 8% range from top to bottom. And that's verified by taking a look down here at the trend for all of these 6 companies over the 2014 to 2019 perspective, courtesy of value line. So an 8% growth rate, 6% margin on average. So we can see that Hibbett actually compares pretty favorably to both of those industry characteristics, top to bottom. Decent quality, decent financial strength, earning stability that would be typical of an economically sensitive company. It could be regarded as oversold right now, and they don't have any debt. So the financial strength is also quite good. So just in summary, pretty close to up straight and parallel, economically sensitive, but not dinged too badly. Even, it's a discretionary retail company. They've actually covered the storms pretty well. Not a new company, 70 years old. So it's been around, been through a few things. And depending on what you're looking at, we're talking about a return forecast anywhere from 16 to perhaps as high as 19%, and that certainly fits the bill. And one of the reasons I like it for bringing it to the tracking portfolio for the roundtable is we do have a fair amount of technology, quite a bit of healthcare, and sprinkling a little discretionary is growing one of the smaller slices of the diversification pie for us right now. So we'll take any questions that you have on that in the Q&A, but I'm going to go ahead and stick Hibbett in the portfolio and hope for the best. So
Mark, could you react to Susan's question? And she wants to know, what exactly does it mean for a stock to be oversold?
Well, what it basically means to the talking heads on Wall Street is that enough people have piled on and sold the company that they've driven the price artificially down. Probably the quickest way to look at it we've got probably have enough time to do this tonight. Let me go ahead and jump out and real quickly show you a picture of oversold. Again, it's very often a more of a technical analysis type situation. If you take a look at a company like Hibbett, you can see that the stock price has been under some pressure, along with many other companies, but the stock price has gone from the mid 60s down to the low 30s. And what most of the pundits look at when they're talking about a stock being oversold is that this has basically been driven down artificially too far. There's been too much selling, and that shows up here at the top in this relative strength index chart. You can find some references to that at Manifest and at stockcharts.com. That's where this comes from. But anytime it gets down below 30, it's technically potentially oversold. So it's potentially attractive as a deeper value turnaround situation. And again, I look at that in combination with the picture we were just looking at. Again, it's been driven way down here, and so technically it's oversold, and maybe that gives you some insight.
Thank you, Mark.
Yeah, you're basically looking at a situation I know that Ken and Sai are probably going to be talking about here, where it's, you're basically talking about a stock price that's way down at the bottom of these bars. Okay, anything else, Ken?
We're up to date on the questions for the most part.
Okay, so with that, we'll go with, again, this has only happened a couple times in 5.5 years. We all choose our stocks independently and hand them in. And I've been assured that there's no conspiracy going on here. And tonight, Ken and Ken have pointed out this. Again, look at that picture. I think I can understand why they're shopping there. I looked at it for a few minutes. So with that, I think, Ken, did you guys agree that you were going to start and then Sai's?
Yeah, I'm going to start, then Sai's going to jump in.
Okay, well, go ahead and take it away, sir.
Okay, well, I'll start with our chant up straight and parallel. If you look at those lines that just was on the screen there, just were on the screen, you'll notice that not only does the red line go right through the green line, which means that it's about as straight as it can get, but we have that blue line, that's the earnings line, fairly parallel to it. And we also have the price bars for the last 5 or 6 years kind of mimicking that same rise. If you were to connect the midpoints of those price bars, I think you'd find a line that's fairly parallel to the other two also. So there's the initial attraction for this stock, plus the idea that I know that this particular industry, the biotech industry, has been savagely gone at by the market. Some of these stocks are trading at 35, 40, 45% discounts from their 52-week highs. So they're not very well loved by the market at this particular point. If you'll click once, Mark. Here's what Biogen IDEC does. They focus on 3 areas: specialty medicines, and you can see the diseases that they deal with in that area, neurodegeneration medicines for the diseases in the middle column, and then rare diseases. They also have some significant products in the oncology area, that's cancer, and that makes up a lot of their revenues. Click again, Mark, if you would. There's so many drug names when you study Biogen or any of the other biotechs that I decided to copy this right from the Morningstar report. It just gives you a real quick idea of what's going on. And Biogen IDEC bases a lot of its revenue, by far the majority of its revenue, just a couple of drugs. The first one is this Avonex, and it's IDEC's leading cancer drug, Rituxan. But these cancer drugs that came from the IDEC part of the Biogen IDEC merger gives a large part of the revenue in today's earnings per share. And then coming from the Biogen part of the merger are these multiple sclerosis drugs, Tysabri and Tecfidra, and they're fairly new drugs, but they're also presenting the company with a lot of profit at the moment. Now, Biogen IDEC has what Morningstar refers to as a very wide moat. They say it has a very vibrant pipeline, and a wide moat means that it would be very difficult for other companies to compete with some of the drugs that Biogen IDEC is developing today because Biogen IDEC has a pretty big head start. Biogen IDEC has a history of being acquisitive, and it should be noted that they just took out a $6 billion loan. Now, ostensibly, the board indicated that was to have some money on hand so they could buy back shares going forward. But a loan that big at very low interest rates and very long-term payment schedules, a loan that large many times signifies that the company is out looking for another company to acquire to add more drugs to its pipeline. If you'll click again, Mark. I like to go here fairly early in my study of a stock, and I like to see a blue line that's the quality of the company as measured by manifest investing, and I like to see that quality up in the 90s for a long period of time, and rising quality, which is generally what I'm seeing from 2012 to the present day. Rising quality is a good thing to see as well. So this quality rose into the 90s and then has stayed there for the last year and a half to maybe 2.5 years even. I also like to see that red graph. That red graph is talking about par values, and I like to see the company with par values in near-term historic highs. So I'm looking at where they've been for the last 4 or 5 months. They've been pretty good compared to history. I go back to 2012 and I don't see any readings with the par value as high as it currently is right now. And the par value has stayed up in that area for a reasonable period of time, and that's a good indicator as far as I'm concerned. Click again, Mark, please. So the next place I look is on a good old-fashioned SSG, and here's the 3 lines you're used to seeing. I just love these lines when they're doing what they're doing. You know, it had great growth. You can practically point to the merger where the slope of the lines changes significantly. You look post 2012 and pre-2012, and you see that there's a change in the growth characteristics of the company. We're basically looking at a new company around 2012 going to the right of the graph. And then I really take a careful look at these price bars, and I notice that the current market has driven the price down really near a 52-week low. That many times for a high quality company indicates a great entry point for a purchase. So let's click again, Mark. Look at the next. Here's section 3 of the SSG, and I'm just pointing out that 52-week low of $254. In the middle of the day today, the stock was at $264, but you can see during the 52-week period, it's been as high as $480. So it's taken quite a haircut to be where it is right now. And you can also see that the average 5-year PE has been about 22, but right today the current PE is down around 17. So again, I'm looking at a stock that if the quality is high and if the growth characteristics stay anywhere near what the growth characteristics have been historically, then I'm looking at a stock with potential PE expansion, and I'm looking at a stock that from my point of view, has a fairly decent return. Now, my SSG, without sharing all of my judgments, I really don't like to share my judgments because I find that people copy my SSGs and then make purchases based on my SSGs. I want you to do your own homework. My judgments indicate that Biogen IDEC has a par value somewhere around 16%. And in reality, the way that I read an SSG is I think that if I were to hold this stock for 5 years and if it were to behave anywhere near where I think it's going to behave, then it'll return me somewhere between 16 and maybe 22% when I sell it, if I were to sell it. That's plenty for a huge company like this one. Remember, the average very large company is expected to return maybe 6, 7, 8%. So when I'm looking at returns like this, I'm looking at returns that normally would come from a very small company. Click again, Mark. I love to go to the Eagle. That's a tool from Manifest, and this is just another version of the stock selection guide where I can play with the numbers, and I can also look at the numbers that are coming from the analyst community. The analysts seem to think that sales will move at about 13% for the next 4 or 5 years. That's very close to my own judgment. The analysts conclude that net margins will be about 27%, and frankly, I think that's a little bit aggressive, a little bit high. I frankly pegged my own margins down around 23.5, 24, 24.5% rather than the almost 27% from the analysts. And because I'm a little bit more conservative, slightly more conservative on sales, a little bit more conservative on net margin, and then on top of that, my average PE is down around 20 for my judgments compared to the average PE coming from the analysts of 23. That's why you're seeing a par value that's higher than my SSG par value. The analysts are suggesting maybe 19% projected return. You know, if I get 19%, that's great, but I'd be happy to settle for 15 or 16% going forward. I can't find anything other than the fact that right now the market doesn't seem to be rewarding these biotech stocks with high PEs or with anything close to the kind of stock price that they've been rewarded in the past. I do note that Biogen probably will put a quarter out tomorrow. It's going to report its earnings tomorrow, and it'll probably put out a fairly average kind of quarter, but compared to what the anticipation is for the company, I think that a very average quarter should more than satisfy the analysts going forward. So my choice is Biogen IDEC. And when I told Mark my choice through my email and attached my few slides here, I noticed that right before me, Cy had also announced he was going to choose Biogen IDEC. So let me turn it over to Cy for his comments. Cy, go ahead.
All right, thank you, Ken. And what I'm going to do, Ken's given you a pretty good introduction to the company. I'm going to, as I frequently like to do on these roundtables, give you an idea where I find my ideas. So I'll show you where I found Biogen IDEC this month and why I chose it. And then I will go ahead and share my judgments, which you'll notice are somewhat more conservative even than Ken's, and I'll just give you a hint, and hopefully I'll remember to come back to it when we get to them. It may be another aspect of looking at this oversold idea. Ken just talked about companies not being rewarded with significant PEs or price appreciation relative to their growth characteristics, and I'll hopefully remember to mention that when I get to my judgments, and you can see perhaps another way of looking at the oversold situation. The first thing that I did, and by the way, I do own Biogen IDEC. I picked some up near the end of last year when it was selling a little bit higher than it is now, but again, as Ken noted, significantly off the high. So I've been watching it for a few months. If you go to the research and the companies tab on manifesting, which is where you can then enter a ticker symbol if you're going to research a specific ticker or something, what first will come up is what you can see here on the screen called a sweet spot screen, which is some of the best ideas looking at stocks that are in the sweet spot and are of high quality. Sweet spot being between 5 and 10 percentage points above my par. When I did that today, preparing these slides and finalizing my selection, Biogen IDEC, as you can see, was the second highest company there. So, and I was looking for a healthcare company to some extent today. That's the reason it did end up in my personal portfolio. But I was looking, as Mark mentioned, Cognizant looks attractive right now, but since I've picked it 10 million times, I was looking to maybe add something different tonight. Next slide, please. So after I get a general idea, I usually go and I take a look at the regular stock report on manifest investing. Here, a couple of things helped confirm my choice, and they may be features that you look at on manifest or perhaps you don't, so I just wanted to mention them tonight. Notice on the right-hand side, next to the actual analysis for Biogen or any other stock that you're looking at, it also gives you a picture of potential candidates to study in the industry, which is drugs in this particular case. And notice that Biogen IDEC is the highest company on that list. And again, this is just combining, taking a snapshot of the quality and the par as an idea. And you can see that it's actually not the highest par value if you wanted to take a look at ENDP there as well, but it's not quite as high quality, which is why on the combination Biogen is at the top, and the same thing in the sector. So this is again kind of a quick comparison guide that you can do that either can show you some potential other candidates to look at, or as I called it tonight, confirming the choice. Another thing that I like to do on the stock page, once I am happy with the basic quality and the return characteristics for the stock, as well as a little bit of competition or peer analysis, is I take a quick look at the quality breakdown. And notice here, that's at the bottom of the screen, and I have noted that each of these four areas, financial strength, earnings, EPS stability, sales growth rate relative to the industry, and profit margin relative to the industry, are all above 12.5%. What that's again telling me in a snapshot is that in all characteristics, not only is it an excellent quality company at 73.8, but that it is above average in the industry in all four of our quality characteristics. So again, very strong. And those of you who listen to the roundtable very much or hear me speak know that I also like looking at financial strength, particularly in the market that we're in right now. And you see that, again, Biogen IDEC has a very strong financial strength at 84 on that. So next slide. I'll go ahead and just jump in since Ken's already talked about the company as far as its business and some of its business environment. I took a little bit more conservative approach on the sales aspect than the analyst as a whole and than Ken apparently did. And actually, it's slightly above what Morningstar is projecting. I noticed one of the questions that we may address specifically is talking about some potential competition in the MS area. And as Ken noted, one of the MS drugs that came in with the merger from the Biogen side has been around for a while and actually is approaching the end of a couple of things. It's approaching the end of a marketing agreement with Roche Pharmaceuticals, which could impact royalties, and also is approaching the end of its patent protection. So some people think that the MS drugs are under significant price pressure, and Morningstar is apparently taking that to heart and are actually projecting a top-line growth in sales as low as 6%. I am not convinced it's that low, but I said let's take a look at what this stock would look like if there is continued sales pressure on the company, and I chose 8% as my projected growth rate. As far as profit margin, right now the profit margin took a bit of a bump in the last couple of quarters, so it's high, but I went ahead and used what's roughly the average over the last couple of years, net profit of 27, almost 28%. Interestingly, while Morningstar, and that's roughly in line with the consensus and with the value line profit margin. Interestingly, as is frequently the case when you study companies, Morningstar is very conservative, as I mentioned, on the, or pessimistic on the sales side, but they are actually projecting a much higher profit margin, actually a pre-tax margin in the 50 to 55% range Morningstar is projecting, which would probably come in around the high 30s on a net margin. So Morningstar is a bit of an outlier, if you will, on the margin respect. But again, gives me some confidence in my projection falling in line with what appears reasonable historically and with what we can see going on with the company. Again, the PE ratio I chose right in line with recent history and roughly the defaults and around where Ken was as well. And my projected annual return, as you can see, is a little bit more conservative or a little bit more low at just 13.2, but still a very respectable return. And I can very easily believe that 20 to 22% range that Ken showed on the upside. So I'm looking at I really think a reasonable low return is in the 13% or so range, which I would be very happy with relatively slow sales growth going forward. But I see significant upside that could achieve somewhere around the 20%, which would be exciting. And this is what I was saying is another way of looking at this oversold characteristic. When you see a company that is beaten up and that there is some question about, let's say, the multiple sclerosis drugs and pressure on high-cost drugs because of insurance power and because of government regulation and just public attention to healthcare costs. If you're concerned about that, go ahead and take a projection and say, well, what reasonably, obviously 0% or zero price is the worst that can happen. That's usually pretty absurd. But what is the lower reasonable range? And let's see what the company looks like if we take those lower projections. And if you still get a return that's decent out of it, then in my language, that stock is oversold. The market has sold more than whatever the fear the market is talking about appears to warrant when you look at it reasonably. So that's how I arrived at Biogen IDEC and why I am recommending it for a addition to our portfolio and for folks to study.
And I think we should make the point, and I'm sure that Cy would agree with me, that since we're doing analysis based on judgments, and those judgments were kind of drawing with big, thick crayons on these lines and everything, that the analyst number and the number that I came up with and the number that Cy came up with are really all in a fairly tight range, and any one of them is probably reasonable. And for that matter, I think I'd settle for the lowest. I'd be happy, of course, with the highest, but I'd certainly settle for the lowest on a company this size as it moves for the next 4 or 5 years. We're getting some discussion here about Biogen IDEC, and you did make the point already that someone wanted to know if they thought that the MS problem could be something. And as the MS treatments move through stage 1, stage 2, and stage 3 trials, Paul, that's your question, they could present some competition to the company, but at the same time, remember that the protection under patent for a lot of these drugs lasts for a fairly short amount of time. Meanwhile, these stage trials that the drugs and the treatments have to go through last for a fairly long amount of time. So the company, Biogen, has room to add other drugs to its stable as the patent comes away from some of the drugs that it's relying on today to make most of its money from. Terry wants to know if Hillary Clinton or any of the other politicians are bothering us in our choice of a drug stock. He says he can remember in earlier elections when these stocks have taken a big hit. And Terry, I've been assured by talking heads on television that if you look back at elections all the way back into the 80s, you will see that these drugs have been under pressure every single time we've had a presidential election, that they're fairly easy targets, even if they're not charging astronomical prices for some of their drugs. They're fairly easy targets to speak about and to portray as the villain. But when it all comes down to what's going on, it costs a great deal of money to develop these drugs. And until we find a better way to fund the development of these drugs, I think that, personal opinion now, I think we might be stuck with fairly high prices until we're willing to support the development without private funding for them. So it's not a new problem that Hillary is talking about these drugs and their prices falling.
In fact,
It's happened a number of times. Go on, Mark.
I might reinforce that a little bit. I had a situation a few years ago. I was looking at a financial analyst journal in the library, and I'm sitting there in the stacks looking through some stuff, and I'm reading the stuff about healthcare and the impact of political pressures and all that stuff, and I'm reading away, and it's, it sounded like literally something right out of, 2008 or whenever I happened to be doing this. So I checked the publication date on it, was in the 1940s. So this is not a new situation, and
No.
that's the way it is. One thing that I thought I might share with respect to what you guys have covered, excellent job, guys. Really it does come down to that growth number, and interestingly enough, Value Line checks in with a 3 to 5 year forecast of about 17%. So they're actually looking at it the other way. One of the things I wanted to point out, this is just a kind of a tip for everybody. We all use Yahoo Finance when we work with our companies. One of the things I do like to do in a situation like this is go ahead and go to Biogen's analyst estimate page, and it just gives you one more opinion. I almost call this a third opinion. And we're going to the analyst estimate page, go all the way down to the bottom, and notice that their growth rate, again, this would be EPS, but they should be roughly the same over the very long term. Their next 5 years for Biogen is about 13%. I always take that number and knock it down by 1/3 when I'm doing kind of a worst case analysis, or maybe even a nominal analysis. So that 13 would literally get knocked down to about 7 or 8. So if I were doing a fairly rigorous study on this company, I wouldn't use Value Line's 17%. I'd be closer to Cy Lynch's 8% based on this. Anytime you use the Finance Yahoo number that is right here on the screen right now, they're always 50% high. And so you want to trim this anytime you use it. Don't ever use it straight up. It's actually fairly rare that that's a reliable number.
Mark, while you're live, we have 3 folks that are wanting to know how to access the Eagle from the Manifest site. Why don't you go to the Manifest site and show them how to get a blank Eagle for a company?
Okay, and while I'm doing that, has Hugh joined us?
I don't see him.
Not yet, he hasn't, no.
Probably getting pretty wrapped up. What you want to do is go in through research, and like I said, my studies, and what you can do is just enter your ticker symbol, and then what we will do is go ahead and grab from publicly available sources a lot of these inputs that you see here and do a quick calculation. And like we were just saying, if I were doing a fairly hard study on this, it wouldn't be too strange for me to drop down to like an 8% there, just see what happens. You can do a sensitivity analysis. And again, you pretty much have size number here. The other thing that I would point out on the company is that the combined company, the company of the most recent 3 to 4 years, does seem to have fairly high margins. You know, if you don't go too far back in history, so something approaching 25 to 30 is not science fiction on the margin side, and that's some of what Morningstar is apparently sniffing at, as Cy was suggesting. So again, you just go to the research tab. It's under My Studies, and you can basically do a quick sensitivity analysis. You can make adjustments. I mean, if you said that you're trailing 5 months or trailing 12 months is closer to that number, again, you can just throw the numbers in and see how it affects your numbers.
I will tell you, Mark, that if you put your ticker in the box that's provided when you first go there, and you have a little bit of problem, it's because you already have a study for Biogen, and Manifest only allows you to have 1 study per company.
Yeah.
So what you need to do is go in and delete the old one, and then you can create a new one at that point then.
Yeah, and what you're literally looking at here is the top line, which is the analyst consensus that we were talking about, and then our conditioned forecast, a little bit less growth in that second slot, and you can see the comparison of the two side by side. And we'll probably be doing some tweaking of this stuff, but the same type of capability will be here no matter what we do.
I'll tell you, if you're in a stock club, this is a great place to show the Manifest numbers, and then the numbers that your stock club might be using for a particular stock. It's a really great place if you take the time to create those studies that might match what your club is predicting rather than what the analysts are predicting. Mark, we have a question for you, or a reaction from you. Faith says that one of the big problems facing any of the small sporting goods change is the fact that Nike and maybe some of the other larger manufacturers are going directly to the schools and colleges now and selling things like uniforms and equipment and shoes, and they're selling them direct rather than going through the local retailers. That's a big revenue stream for the local sporting goods stores to be able to supply the local school districts and any colleges or universities that might be in the area. And the companies are bypassing their retailers. Do you see that as a potential issue for these sporting goods stores?
Yeah, I certainly would see that as a challenge. I don't know how pervasive that is. Does it get down to a wide berth when it comes to the high schools? I'm very familiar with what they do with colleges, but Nike is quite well, Adidas is also, but Nike is quite forceful, and they're an 800-pound gorilla. So yeah, that's something that I think any of them would have to be aware of. Be interesting to take a look at the split, call it commercial versus retail sales. And I do not know what that breakdown is, but it might be an interesting question to pour over and see if the company even mentions that as a consideration or a threat.
Okay. Bill wants to know how much does Biogen IDEC spend on research and development as a percent of sales? I will tell you, Bill, that Biogen IDEC's investor relations site is full of presentations and full of really good not only visuals in the form of PowerPoints, but also audios to go with those visuals. And that should be something that you should be able to find by going to their investor site and doing some research for yourself if in fact you're interested in this particular company. Sharon wants to know, is the buying back of stock with a large loan necessarily a good idea for the company? And Sharon, the information that I got off of the Biogen website and out of some of the analyst reports that I read was that the company had used that as a reason for the $6 billion loan, but nobody really seemed to think that they were going to spend all that money buying back stock, that they were getting cheap money onto their books. They were going to be very able to pay the interest on that money over a long period of time, and everybody seems to think that that's just a transparent excuse right now for building a pile of funds to do some more acquisition. The company has been quite acquisitive the last number of years, and especially the large merger between the two companies points to that. So whether it's good or not, nobody seems to think that Biogen IDEC is going to use $6 billion to buy back stock. CG says, where is all the data being pulled from? Some of the data that Mark is showing you is coming directly from Value Line. Some of the data that Cy and I showed you is coming from Morningstar, and some of the data on the Eagles is coming from a combination of sources that have been kind of put together, and they're called analyst consensus numbers. Mark does that as a matter of course for every single stock in his database. So there's not a simple answer for where the data is coming from. I would urge you to know what's being done with your data. Morningstar data, for example, is GAAP numbers as reported to the SEC. Value Line data sometimes is GAAP, but a lot of times it's non-GAAP, which means they've excluded one-time only charges. And of course, analyst consensus numbers are forward-looking numbers, so they're in fact just the opinions of the analysts that happen to follow the stock we're talking about. That might be a couple of people. In the case of the numbers in Manifest, Mark, it's a conglomeration, what, of 4 or 5 sources, providing the numbers exist in those sources?
Absolutely, yep. S&P, Morningstar, Value Line, a couple other things, the analyst consensus, that sort of thing.
Okay,
Let me,
I'm trying to follow your questions. And Mark, before you go, Marie has a question for you. She said, are you concerned about the fairly high level of shorting on the Hibbett stock?
No, I have not actually looked at that. I don't look at shorting very often. You know, with the price being as oversold as it is, I probably wouldn't be quite as concerned as if it was in the opposite condition. I would actually look at that as a potential advantage. If that price gets, it could be a good situation. But there's obviously somebody out there that's betting against the company, perhaps for some of the reasons that Faith has brought to our attention. But it's worth taking a closer look at that stuff.
And again, it's not a long-term, not something that we as long-term investors taking a long-term approach would look at, but realize that if there is significant short interest in a stock, that means that a significant number of people are borrowing shares and selling them, contributing to that oversold situation that Mark was talking about, or potential oversold. What happens, realize those people don't own the stock. they're borrowing it. They are leveraged, hoping to make money for continued price decreases. If that stock turns around and starts going up significantly, you can end up with a situation called a short squeeze, which is when the brokers start asking those people who borrowed the stock to repay the stock or to put up more margin, and they end up having to buy the stock, and you can actually, for a short period of time, end up with the opposite side, which would be an overbought stock because the short sellers are covering their position, and you'll see a very rapid run-up of a
Yeah, no,
stock.
when you're a shareholder in that situation, it's fun. I mean, the most recent one I can think of was BioReference Labs that many of us held.
Exactly.
I mean,
Yep,
that was a huge.
Mark, we have George with his hand up. I'm going to unmute him, and George, you're unmuted. Go ahead. George, you're muted on your end. So if you're trying to talk, you have to unmute yourself on your end. Okay, that's evidently an inadvertent hand, and I'm going to remute George and take his hand down. And Mark, you were going to go somewhere else now? Go on.
Yeah, I don't think he's been able to join us, so I'm going to go ahead and toss Conoco Phillips in for him. Just give me a minute or two just to share some of the highlights here. One of the reasons he's not with us probably is because he's shopping for stocks. Those of you that follow Manifest Investing know that he's been accumulating a bunch of companies lately. And a lot of the story revolves around the fact that many companies are hovering down near their 52-week low, which is when he really does kind of kick into overdrive and his attention kicks up. Notice that Biogen IDEC is right here, pretty close to the 52-week low, or very close on the list. So that's showed up in a number of places, but you can see a number of financials on here. Middleby, interesting. Gildan's probably fairly interesting, perhaps even as it's not in Hibbett's industry, but some interesting stuff. But again, the moral of the story is, if you looked at this a year, 18 months ago, there wouldn't have been any companies here, maybe one or two falling into that proximity to the 52-week low. So he has actually been accumulating a lot of stocks here lately. Here's a look at Conoco Phillips really quickly. The analyst consensus for the company is probably double digits, whereas Value Line has been a little bit more conservative. You do have to break out the fact that this is the pre-Phillips 66 timeframe, so we're talking about the company after that split. They have had a rough 2015, probably will have a rough 2016, but that never bothers Hugh. He just looks at that as an opportunity to accumulate. If you think that the usage of petroleum and fossil fuels will continue, and basically what will happen is, again, forget all this stuff here because that's the old company. It'll flatten out and perhaps have about a 2 or 3% growth rate going forward. Interestingly enough, when you take a look at a company like Conoco Phillips, sometimes you do have to look at a price to cash flow situation. Value Line does that. You can see some of the numbers there. In the absence of anything else, there's just a couple things here that we look at. One is that the price has been cut in half from last year's high. The Value Line low total return forecast at a price of 51 was 9%. So it isn't, the company is actually down to a stock price of 35. So again, Mr. McManus sees that as this is a company that's probably not going to disappear from the planet and is probably fairly grossly undervalued at this point from a long-term perspective. That's why he's adding it to the portfolio tonight. So that's just a quick rundown as to why he wanted to get that in there. And I think we can go ahead with the poll count if you're ready.
Okay, give me just 1 second here, Mark.
And we will have a little bit of time for Q&A if people want to dig in a little bit deeper on some of this stuff.
Okay, and here's our poll. Please tell us which stock you would like to place in the tracking portfolio.
Do we really have to do this? Oh, if I don't get more votes than none of the above, I'm leaving the room.
You were ganged up on, Mark.
Well, we did a double team on you, Mark. So
That the last time this happened, it was Universal Display, ticker symbol OLED, and that's worked out pretty well for us.
Yeah, that was I was picking it and you were picking it at that time, I think, right?
I don't remember the other
We're
one.
gonna give people about 5 more seconds. We have almost 90% of the audience voting now.
I'm going to send Christmas cards to anybody voting for Hibbett.
Last chance here. Okay, so I'm going to close the poll and I'm going to share the results. And here are the results. So we'll add a third position in Biogen IDEC to the portfolio. That was the overwhelming choice for this time.
That's going to make the top of the top 20 on its first time out.
I'll tell you, Si, he's going to have a really big "I told you so" if this doesn't work out. You know that, don't you?
Yes, I do.
That's only somewhat true. I wasn't kidding. You notice how many times it showed up in all those other screens and everything. So I mean, it was very high on the top of my short list. I just wanted to do something different. And plus, I did.
Mark, some of the people are saying, Mark, that they're sorry. Marie says she just hates retail, however, and she couldn't in good conscience vote for a retail stock. So
we got to work on that.
Okay.
Good stuff. All right. So
and Shirley has a good comment, Mark. She says these are recorded, aren't they? So she can listen to them again. And Shirley, it's correct. They are recorded, and we post them on YouTube, on the Manifest Investing channel, and we also post recordings on the Manifest Investing site under events. So they're there in a couple places for you to take a look at if you need to listen to them again. All right. Mark, you were saying something?
Oh, let's see. What am I looking for? Events. I was just going to show people what they actually look like online. When Kurt posts the recording, they actually show up with this little icon right here. And if you click through on that, you can actually get directly to the recording. So again, it's manifestinvesting.com/events. This is a public page. It's a completely public page, no subscription required. So you can go back to any. You can see the October one here, and yeah, it's an area that could be very fertile with humility. You know, you go back and look at something that you said 5 years ago or 10 years ago, and that's why I take my hat off to anybody who's willing to make a stock pick. And those of you that are in investment clubs, you know the feeling. I mean, it's strength in numbers is a good thing also.
Mark, Norm has a really interesting suggestion. He'd like to be able to have an eagle for his personal numbers, but he'd also like to be able to attach eagles to club stocks in his club account. So maybe that can be added to the wish list. Norm, it cannot be done right now. You can only have one study per stock, but that is an intriguing idea, isn't it, Mark, to be able to attach eagles to your club account?
Yeah, and just thinking out loud, it might actually go down that same path that we do for supporting the clubs, having that dedicated area for club dashboards. Could be an emulation of that type of concept.
Yeah, yeah. Mark, Herb would like to know, what about the groundhog contest?
The groundhog contest, yeah, and I meant to put a slide in about that. Yeah, for those of you that are not familiar with the groundhog contest, we do a stock picking contest every year on Groundhog Day. Actually, will end, I think it's next Tuesday or something like that, February 1st, and then a brand new one will start. All you need to do is send a minimum of 5 and a maximum of 20 stock selections to me, either by email or post them in the manifest forum. There will be a post available for that shortly. I actually have a few submissions already in, and interestingly enough, it looks like our ladies from St. Louis just might win the group competition again this year.
Well, I've done so well this year, Mark. I'm eager to join again next year. You know, I'm just chomping at the bit. I've done so well this year. So
well, there will be more information on it out tomorrow. I'd hope to get it out today, but again, we just invite everybody to submit 5 selections, and in fact, the individual winner this year could be somebody's wife who just tossed out 5 based on some companies that her club was studying at the time, a year ago. So it can be some good, clean fun, and we've been doing it 8 or 9 years. So we do keep track of the long-term results also. And
Marty wants to know, before you announce the winners, you will be adjusting for splits, etc., right?
oh yeah, we buy pizzas for the accountants and pizza and beer.
Marty seems to think his account might need some adjusting.
Oh, I know.
Mark,
Go ahead.
Don is referring us to the workshop you and I are going to run in Chicago this coming Saturday,
Mm-hmm.
and he wants to know, are people going to be able to log into it and listen to it?
Yeah, we're going to actually broadcast a couple of the segments starting Saturday morning. So we'll probably do at least 50% of it available across GoToWebinar. You can actually take a look at, again, go back to the Manifest Investing site. What Don is referring to is this Chicago seminar. You can sign up right here for the session. And we're going to be live with a group of about 40 or 50 investors in Chicago. But at the same time, Ken and I will be presenting, and we'll basically let people from all around the country tag along. It's a complimentary workshop, so we look forward to having a little bit of fun.
Okay, Jerry would like to know if anybody would like to hear some comments on Air Lease, which had a big drop in price lately.
Well, you need to open up Matt Spielman's microphone, if he's still around. There's an excellent thread on the Manifest Investing site on Air Lease.
Matt has his hand up, so I'm going to unmute him. Matt, go ahead.
Yeah, hi guys, can you hear me?
We can hear you just fine, Matt.
All right. Yeah, I don't know if this is an update more than a reiteration. I think the important thing is that there's really been no change in Air Lease's business, no announcement that would mean that the price should go up or down. Its customers are the airlines, and airlines use oil, and they also finance a lot. So I think everything, even though it's a very large movement, and it's off the bottom, a couple bucks off the bottom, but down from the mid 30s, is about the industry around it, not about the business. They don't report Q4 earnings or full year 2015 earnings until next month, so it'll be tossed and turned around for a while. But I personally see no difference in Air Lease. It's very important to remember when you're looking at short-term movements. Air Lease sells their leases, the planes that are coming off the business, 18 to 24 months ahead of time. So they've almost, by the end of the third quarter, if you go back to that report, they had sold 96% of 2017 deliveries. So their business through 2017 is done, is booked already. And once that gets booked, once the lease starts, they go on for 10 years. So they have a runway of 12 years of known business ahead of them, and still develop more each year. And so I think that for a small company, and particularly a young company, and this is deceptively young because it started in public in 2011, but most of the leadership has been in the business for 30 years. It has a stability that certainly even the airlines don't have, but most small businesses don't have anywhere near that stability in their transactions. So things move around quite a bit, but it's nothing about Air Lease, the company itself.
And I'm just showing on the screen while you've been talking, Matt, under the stocks folder in the Manifest forum, Matt posted a bunch of links which basically provide the substantiation for a lot of stuff he's been talking about. And there's just all kinds of trade and industry-specific and company-specific publications.
One thing you look at, if you go to the IATA website, and something that's really impacting the airlines, air cargo, just like a lot of kinds of cargo, has really dropped off quite a bit. And in fact, air cargo has dropped off about as much as passenger traffic has gone up. So cargo planes, although the OEMs do sell new cargo planes are often conversions of old passenger models. And Air Lease does not have any cargo planes in its fleet. So that's another particular divergence that you'll see among some customers versus Air Lease is pull out the cargo results and you'll see really a dichotomy of the industry today.
Matt, I want to make sure I heard you correctly. Basically, what you're saying is there's been nothing major to change the outlook of the company going forward, and we're just looking at a price drop. So if you thought it was a good buy prior to the price drop, it's a better buy right now. Is that what basically you're saying?
Yep, very much so.
Okay.
Yeah, it's another one of these situations where the guide or the stock study results doesn't match what you read in the newspaper or see on CNBC.
Someone's going to be awfully surprised one way or the other.
I don't know. You make an awfully good case for it.
We're getting a question from Norm, and I'm not sure whether it relates to the Air Lease or not, but it says, how long can an airline lock in their fuel costs into the future? Does anybody know how long you can hedge your fuel into the future?
Well, I'm sure for a price you can go pretty long. I know Delta Airlines, whose CEO's comments have caused some turbulence for Air Lease before, is just rolling off their hedges this year. So if you think that it's been about 18 months, they were hedging more or less 2 years into the future. Whether that's typical or not, Delta may not be typical because they actually have a very long fuel hedge. They actually bought a refinery that a oil company was closing a couple years ago. So maybe to take my words back, that's a direct monetary hedge. But they actually went into the oil refining business as a permanent hedge against fuel prices.
Wow. I do know that Southwest Airlines had a multi-year, I don't know if it was year-over-year type hedging, but it was for quite a period of time, and it did expire, I believe, last year. And I don't know that they picked up any type of aggressive or assertive hedging at that point.
I don't do a lot of study in the airline industry, but I do a lot of study in the trucking industry, and I know that trucking companies typically hedge fuel out as far as 18 months to 2 years. So I don't know if there's any relationship between the two industries or if that's usual or unusual, but you are able to hedge at least 18 months to 2 years for these international and national size trucking firms.
And for those that did, that's actually a drag in these prices. They want to get to market prices as fast as possible, but then it'll be interesting as things stabilize or go back up, everyone will pile back into them.
Yeah, they devoted some time to that on the night transportation earnings call about the fact that their fuel prices weren't falling as quickly as people might anticipate because they had hedged fuel that they had purchased. I don't see any other. Thanks, Matt, for your input. We appreciate it. I don't see any other questions, Mark. Everything seems to be cleared. Faith is indicating that this whole concept of closing the retailers out of the loop for sporting goods is happening at all levels of play. So it's happening at the high school level and the junior high level, and I would assume, even though she didn't say it, it might even be happening at the youth level, where the companies are selling things directly to the organizations that run these different programs. So instead of somebody from the local sporting goods store coming in to sell shoes to everybody, now there's somebody from one of the companies coming in to sell shoes to everybody. So interesting.
Certainly a consideration, and I know that she's very close to that topic and certainly has a lot of local knowledge. So anybody out there listening, pay attention to Faith. So I think we're in pretty good shape here.
Faith is saying that it's happening to individual consumers, this direct sales thing. So that's obviously something that you should factor into your stock studies as you're looking at some of these things. Joe wants to know if I have any comments on the trucking industry. Joe, no, not tonight. I don't feel that it's a particularly desirable place to be investing at the moment. But the cyclical nature of the trucking industry isn't nearly as dramatic as the cyclical nature of a lot of other industries. And therefore, I feel that some of the really high quality truckers can be used as long-term holdings. I've held Knight for a large number of years. At various times, I've held Old Dominion, I've held Forward Air, and I think that they can serve as fairly long-term investments if you look for the very high quality trucking stocks, especially those that are able to attract and keep their drivers. That is one of the big sticking points in the trucking industry is attracting and then keeping high quality drivers on the road. Mark, Bill wants to know, where can he find the most recent Sweet 16 post?
I actually attached the Sweet 16 to this forum thread for the roundtable, so you can find it there, Bill. By the way, happy birthday again, Bill. If you go to in the forum under stocks and under roundtable, it'll actually be right there. And I'll be posting tonight's presentation at the end, but it's right here also.
Mark Faith says that she found the news release that she was referring to, and she will post that release on Facebook when you put the recording up.
Okay. Thank you very much.
Thanks, Faith. We appreciate that. I think, again, I've cleared the questions. I say that, and then we always get one or two added.
Oh,
I don't see any hands in the air, so
my wife.
Happy New Year to Cy and to you, Mark. And Mark, we'll talk tomorrow about how we're going to get to Chicago on Friday. And other than that, have a nice evening, everybody. Thanks for coming. We appreciate your attendance. And Cy and Mark especially, we appreciate your help in doing all these things.
You're welcome. Thanks, everybody.